In the third quarter of 2025, the world said it was sitting on $13 trillion in foreign exchange reserves. 13 trillion. That is not a typo. Well, 4% of the currency composition behind that number wasn't directly reported at all. It was imputed, estimated, reconstructed. In other words, the public was handed a clean headline while a meaningful slice of the underlying reality was filled in after the fact. Now compressed time. Not months, not weeks. A collateral chain can snap. A currency swap line can become the only bridge. And the moment that happens, the question isn't how big reserves look on paper. The question is, which reserves are real, usable, and immediately deliverable? They said this could never happen in modern finance. They said transparency had improved. They said reporting standards had matured. But the data is telling you something more uncomfortable. Institutions already understand the difference between reported reserves and real reserves, and they behave accordingly. Most people don't notice until the news hits. What I'm about to lay out isn't a theory. It's a pattern you can measure. It shows up in which assets central banks are accumulating. It shows up in the plumbing, where foreign official institutions park liquidity when they don't want exposure. And once you see it, the story of reserves stops being a comforting statistic and starts looking like a pressure gauge. Welcome to Signal Ledger, where we decode what matters before it becomes a headline. If you like calm analysis that follows the data instead of the noise, consider staying close. And if you're listening right now, drop a comment with where you're watching from, because this story is global and the signals look different depending on where you sit. Here's the event most people missed because it didn't arrive as a crisis headline. 92%. On the surface, that looks like continuity. A dollar share still above half. A large pool of reserves. A system that appears stable, but then the footnote matters more than the headline. Starting with 2025 Q3, the IMF changed its methodology so that part of the currency composition is imputed. Instead of a visibly large, unallocated bucket that told you plainly that many holders were not disclosing their currency mix, the data now includes staff estimates for a portion of the total. 4% of total reserves had currency composition imputed. That sounds technical, but it's a philosophical shift. When a data set moves from this is what was reported to this is what we believe the reporting implies, you gain continuity in charts and lose clarity about stress points. And stress points are exactly what reserves are supposed to cover. The real reserves problem is simple. Reserves are not just assets, they are options. Options to settle, options to intervene, options to meet obligations. In a currency the market will accept in size, at speed. A reserve that cannot be mobilized in the moment you need it is not a reserve. It is a statement. To understand why central banks don't crave full transparency, you have to understand what transparency reveals. The mismatch between ownership and control, between book value and settlement, value, between legal title and practical access. And we've seen the playbook before. In 2010, the Bank for International Settlements disclosed that it had taken 346 tons of gold in swap operations in exchange for foreign currency. Gold swaps are not mysterious. They are a mechanism. A central bank can obtain currency liquidity by swapping gold as collateral, often with an agreement, to reverse the transaction later. In calm times, that can look like routine liquidity management. In stress, it is emergency oxygen. Notice what that implies. If you can swap gold for currency, then gold is not just an inert relic on a balance sheet. It is a form of collateral that can be mobilized when trust is scarce. And when trust is scarce, the market cares about what can settle, not what can be explained. Go back further and you see the same rhythm. In 1997 and 1998, during the Asian financial crisis and the Russian default era, countries learned that reserves that look large can evaporate when capital flees and exchange rates gap. In 2008, the world learned that dollar funding can disappear even while official reserves look enormous because private markets can overwhelm public buffers. In 2020, the world watched dash for cash dynamics appear in days, pushing central banks to open facilities and swap lines at speed. In 1997, the lesson was that fixed exchange rate promises can be broken when reserves are insufficient relative to liabilities. Result, abrupt devaluations, IMF programs, and long periods of rebuilding. In 2008, the lesson was that reserves do not prevent dollar shortages in a global banking system that relies on wholesale funding. Result, swap lines, emergency liquidity, and an implicit hierarchy of access. In 2020, the lesson was that even the safest assets can become hard to finance and panic. Result, official backstops became the difference between a liquidity shock and a solvency spiral. In 2024 and 2025, a quieter version of that lesson is being learned again, and you can see it in the assets central banks favor and the reporting choices they tolerate. Look at gold. In 2024, total gold demand reached 4,174 tons. a record annual figure. Central banks bought over 1,000 tons for the third year in a row, and in the fourth quarter of 2024 alone, official sector net purchases were 333 tons. That is not retail jewelry demand. That is not a speculative trade. That is policy. Why would official institutions keep accumulating a non-yield asset in a world that claims to have deep liquid reserve markets? Because gold has two properties that matter in crisis. First, it is not someone else's liability. Second, it can be used as collateral across borders when other forms of trust are questioned. Now look at the plumbing. The Federal Reserve's foreign repo pool is a facility that allows foreign official institutions to park U.S. Treasury securities and receive dollars overnight. In the third quarter of 2025, the level associated with this pool was about $376,213 million. That number isn't a headline, but it is a behavior. It tells you that foreign official holders value a place to convert treasuries into immediate dollars without having to sell into the market. That's a clue. In a world where treasuries are supposedly the most liquid asset on Earth, why would you prefer a facility designed for official access? Because liquidity is not just about the asset. It is about the market state. In stress, selling can move prices. Using a facility can avoid signaling and avoid slippage, and signaling is the hidden enemy of transparency. If a central bank discloses, in real time, that it is shifting currency composition or mobilizing certain collateral, it can trigger market reactions that make its job harder. Transparency can become a self-inflicted run. To make this concrete, look at who sits around the table when reserves are discussed. It is not just a finance minister and a headline figure. It is a reserve management desk, a market operations team, lawyers who read settlement rules, and a small group that thinks about sanctions and cross-border enforceability. The IMF aggregates disclosures. The BIS can intermediate liquidity. The Federal Reserve runs facilities that matter in the funding currency. The ECB, the Bank of England, the SNB, the BOJ, and others all operate in a network where trust is both operational and political. This is why one phrase can mean two different things. That gap is the real reserves problem. In 2008, it became visible through dollar swap lines. Shortages appeared outside the United States, even where reserves were large, because the shortage was about funding flows, not the stock number in a quarterly report. The response was not simply to sell reserves into the market. The response was to exchange currencies through official swap lines and then lend dollars locally. That is, usability, access arriving through architecture. In 2020, the dash for cash repeated the lesson. When the safest assets were hard to finance, official facilities acted as pressure valves. The point isn't that history repeats perfectly. The point is that the same toolkit shows up when stress hits: swaps, repos, collateral, and quiet channels. Quietness is functional. If a central bank announces, "Tomorrow we will sell 10 billion of currency A," the market moves first, spreads widen. You pay more. You signal weakness. If instead it repos treasuries, draws on a swap line, or temporarily swaps gold for currency through an intermediary, funding arrives with less footprint. That's why transparency is never free. There's another dislocation: valuation versus liquidity. A reserve asset can be marked every day, yet still be costly to liquidate at scale. $1 trillion in securities is not $1 trillion in spendable cash. In calm times, the difference feels academic. In stress, it decides outcomes. Now return to gold with that lens. Gold is not only about returns. For a central bank, gold is a political asset. It sits outside the credit system and does not require another issuer's promise. In a world where access can be questioned, that matters. And when official buyers take over 1,000 tons a year, they are building redundancy: dollars for settlement, gold for last resort collateral, and facilities for moments when markets seize. If you've ever wondered why the public never gets a perfect real-time line-by-line map of reserve composition, this is why. That map would not be neutral information. It would be a trading signal, a diplomatic lever, and in a panic, a trigger. And the move from visible unallocated to partly imputed composition fits the same logic. When the unknown is shown openly, analysts can point to it, compare it across quarters, and treat it as a risk factor. When the unknown is blended into estimates, the chart looks smoother, but the uncertainty does not disappear. It is simply hidden inside a model. In stable periods, that can be fine. In unstable periods, smoothing delays recognition, and because markets trade what they can infer, not what they are told, reducing visible unknowns is itself a form of intervention when pressure is rising. Now bring in a third signal: the politics of ownership. Italy's gold reserves are often cited at around 2,152 tons. The precise debate around who controls those reserves and under what legal framework highlights a reality that many people gloss over. Reserves are not just numbers, they are institutional arrangements. Who can pledge them? Who can move them? Who can forbid their use? And what happens if political leadership changes the rules? Central banks, by design, sit at the intersection of markets and sovereignty. They need the credibility of independence, but they also operate in a world where legal and geopolitical constraints can change quickly. When you increase transparency, you expose the pathways by which constraints can bind. This is where the dislocation becomes visible. On one hand, the official reserve data shows stability, a $13 trillion pool, 92%. On the other hand, central banks are accumulating gold at a record pace and using official facilities to ensure dollar access. And on yet another layer, reporting is shifting from direct disclosure to imputation. Those signals do not align if you assume reserves are just a static stockpile. They align perfectly if you assume reserves are a dynamic toolkit in a world where access can be restricted. The real reserves problem is that the public sees stock, while institutions focus on flow. The public sees totals, while institutions focus on what can be converted today in size, without destabilizing markets or triggering retaliation. Consider a reserve held as deposits or securities in another jurisdiction. In normal times, that is liquid. In abnormal times, it is conditional. Conditional on legal access, conditional on settlement systems, conditional on counterparties being willing to transact, conditional on the political climate. Now consider a reserve held as physical gold, stored domestically with clear title. That is also conditional, but in a different way. It depends on logistics and collateral acceptance. Yet historically, gold has been accepted when trust in other promises weakens. That is why, when the world becomes more fragmented, gold reasserts itself as a reserve asset. Here's where it gets interesting. The methodology change in COFER does not necessarily mean the underlying world is less transparent than before. It may mean the dataset is being optimized for continuity and analytical use. But the timing matters. It arrives in a period where reserve composition is politically sensitive, where certain holders prefer not to disclose, and where the market would react to visible shifts. If, before 2025 Q3, a large unallocated bucket told you that many countries did not report their currency composition, you could at least quantify the unknown. After the change, part of that unknown is replaced by imputed composition. The chart looks more complete, but the line between known and estimated becomes easier to ignore. That's not a trivial detail. In risk management, the difference between measured and modeled is the difference between a dashboard and a guess. Models can be excellent, but models can also smooth away the very discontinuities that matter in crisis. Now, layer in institutional movement. When central banks buy over 1,000 tons of gold for 3 consecutive years, they are not chasing momentum. They are altering the nature of their reserve toolkit. When official institutions use the foreign repo pool, they are not making a yield decision. They are protecting access. When the BIS engages in gold swaps, it is not doing a retail trade. It is facilitating liquidity for institutions that need currency now and have collateral that markets will accept. The number 346 tons in 2010 is a reminder that reserves can be mobilized in ways that are not fully visible in simple monthly tables. So what doesn't match? 92% in 2025 Q3. Yet the behavior says something else. Official sector diversification into gold continues, and the architecture for accessing dollars in stress remains essential. That is not a contradiction if you accept that institutions want both: dollar liquidity for immediate settlement and non-liability assets for resilience. The dislocation is between paper allocation and crisis functionality. Paper allocation is what the reports show. Crisis functionality is what the facilities, swaps, and vault movements reveal. Let me show you the evidence in a way that matters. $0 trillion total, and ask a simple question. How much of that can be mobilized in 48 hours without generating political risk, without moving markets against you, and without revealing vulnerability? 4% imputed share? 4% of a small number? That is a meaningful portion of a $13 trillion system where the currency mix is, by definition, politically and strategically sensitive. Even if the imputation is statistically sound, it tells you that full transparency is not the operating norm. Now add the foreign repo pool, $213 million in Q3 2025. That's roughly $376 billion. It's not a measure of panic by itself, but it is a measure of preference. Official institutions value an assured pipeline to dollars. Add gold demand, 4,974 tons in 2024. Then isolate the official component, over 1,000 tons for the third year running, and 333 tons in Q4. That is a sustained behavior, not a one-off. It suggests that central banks are building a hedge against something that cannot be diversified away with more paper claims. Now, zoom out to the mechanism. How is reserve reality managed when stress appears? Often through a sequence that looks technical, but is deeply strategic. First, you preserve liquidity. You hold assets that can be converted without selling. That includes access to repo facilities, swap lines, and official windows. Second, you preserve optionality. You hold assets that are widely accepted as collateral even when confidence in institutions weakens. That includes gold. Third, you preserve ambiguity. You avoid disclosing exact moves in a way that invites front-running. Front-running is not a conspiracy. It is how markets work. If you announce you need dollars, the price of dollars rises. If you announce you are selling a currency, that currency falls. If you announce you are mobilizing gold, the market infers stress. Transparency can worsen the very outcomes reserves are meant to prevent. Think of reserves like the fire exits in a crowded building. In normal times, you can publish a detailed map and everyone feels safe. In a fire, the map is less important than whether the exits are clear, unlocked, and not blocked by the crowd. If you announce that one exit is blocked, everyone rushes the remaining exits and the problem intensifies. Central banks manage the same psychology at a national scale. A reserve portfolio is not just a balance sheet. It is a confidence instrument. And confidence is fragile. So what does this mean going forward if the pattern continues? Historically, when transparency becomes more managed and reserves are mobilized through collateral channels, the system is preparing for a world where settlement matters more than narrative. One conservative scenario is that nothing breaks, but the toolkit keeps shifting. Central banks continue to hold the dollar for liquidity, continue to buy gold for resilience, and continue to rely on official facilities for smooth funding. The public sees stability while the architecture quietly adapts. A moderate scenario is that geopolitical fragmentation and sanctions lead more holders to avoid visible currency disclosures, increasing their reliance on imputation and reducing the market's ability to see shifts in real time. In that environment, dislocations between official composition and effective composition widen, and markets become more jumpy around any hint of repositioning. An aggressive scenario is a liquidity event where access, not ownership, becomes the binding constraint. In that world, the question is not who has reserves, but who can use them without permission, without delay, and without stigma. That is the world where real reserves become a decisive advantage. If you want to know what to watch, keep it simple. Watch the share numbers, but also watch the footnotes. Methodology changes matter. Watch official sector gold accumulation, especially quarterly spikes like 333 tons in a single quarter. Watch usage of official dollar facilities like the foreign repo pool. Right. Words shift before policies do. Because this is not opinion. This is pattern. When institutions feel secure, they disclose more and rely less on collateral tricks. When they feel the ground shifting, they hoard optionality, secure access routes, and manage what the public can infer from the data. The choice ahead is not about optimism or fear. It's about attention to the signals that institutions cannot hide because they have to operate. Those who track only headline totals will believe reserves are a simple shield. Those who track usability will understand that reserves are a contested resource in a world where transparency has a cost. And the cost is not just embarrassment. The cost can be a run, a currency move, a funding squeeze, a political confrontation, or a loss of negotiating power. Central banks don't avoid transparency because they enjoy secrecy. They avoid it because, in crisis, the market punishes honesty about vulnerability. There will always be a divide between those who watch the press conference and those who watch the balance sheet plumbing. It's not about being smarter. It's about looking where incentives force truth to appear. The wealth gap, again and again, is an information gap. Institutions move first because they can see the pipes. Retail moves last because it only sees the headlines. This is signal ledger, where we decode what matters before it becomes a headline. If this connected dots you hadn't seen, you know what to do. And remember, the real question isn't whether the reserve story changes. The question is whether you understand what reserves actually means before the next 48 hours proves it. Today.